Hello everyone, it's Wednesday, October 22. Today we're analyzing the euro and British pound charts to assess potential market moves. As you can see, the euro continues to trade with a bearish bias, weighing down by subdued demand and current geopolitical uncertainty. Market participants are closely monitoring developments ahead of the anticipated meeting between US President Donald Trump and Chinese President Xi Jinping. In his usual manner, Trump has oscillated between optimism and confrontation, first expressing hope for productive talks and then warning of a potential 155% tariff on Chinese imports beginning November 1. He has also suggested that the meeting may not take place at all, further confusing markets and dampening investor sentiment. This mixed signals from the White House are doing little to support demand for risky assets, as traders remain wary of increasing uncertainty. Nevertheless, there is still some hope for a near-term resolution to the US-China trade impasse. Adding to the cautious mood is the prolonged US government shutdown, now in its 22nd day, which has delayed the release of key economic data on both sides of the Atlantic. The resultant data vacuum is making it more difficult for investors to assess the underlying health of the Eurozone and US economies, weighing down on risky assets and further reinforcing the bid for the US dollar. The British pound is experiencing a similar dynamic. While sterling's retreat has been somewhat more limited compared to the euro, it remains under pressure. Now let's turn to today's macroeconomic calendar, which is loaded with the key releases from the United Kingdom. The highlight will be the latest read on UK inflation. The headline Consumer Price Index is expected to rise to 4.0% year-on-year in September, up from 3.8% previously. While no monthly inflation estimate is published, market participants are likely to focus on core CPI, which excludes volatile food and energy prices. Core inflation is projected to edge slightly higher from 3.6% to 3.7%, a figure closely watched by policymakers. With the Bank of England recently signaling it is unlikely to cut interest rates this year, an upside surprise in inflation would reinforce the central bank's cautious stance. A stronger than expected print would not only reaffirm that view but also serve as a warning sign for the UK economy. Adding to the backdrop of uncertainty is the political gridlock surrounding the UK's fiscal policy. Delays in budget approvals and broader political instability are contributing to a fragile macroeconomic environment. These factors, combined with sticky inflation, could weigh heavily on the pound in today's session, especially if the data surprises to the upside. Also on the agenda are UK retails and producer price figures, which will provide a broader picture of domestic inflationary dynamics and could spark increased volatility in the market. As for the euro area, today's calendar is relatively light, featuring only scheduled remarks by European Central Bank President Christine Lagarde and several ECB officials. In the United States, attention will briefly shift to a speech by Federal Reserve Vice Chair for Supervision, Michelle Barr. However, he is not expected to break new ground ahead of next week's FOMC meeting, where market broadly anticipate a rate cut. Any comments are likely to reiterate the Fed's current monetary stance. Turning to technical analysis, the 1-hour EUR USD chart shows that a decline followed by a false breakout at 1600 would generate a buy signal, potentially pushing the price towards 1629. At this level, I anticipate seller interest to increase. If not, a break in consolidation above this level would lead to a rise to 1655 and possibly open the path toward 1675. At this mark, I would recommend going short on the rebound, counting on an intraday correction of 15-20 pips. Short entries at 1629 and 1655 would only be justified in case of a false breakout. Alternatively, if the price breaks below 1600, the euro could slide to 1575 and even extend weakness to 1545. At this level, it would be prudent to go long on a rebound, targeting a 25-30p move. Long positions at 1575 and 1600 would only be relevant on the false breakout. Speaking of the British pound, sellers are expected to become active around 33.95 level. A false breakout at this mark could provide a signal to open short positions with a target at 1.3362. If the price breaks and consolidates above 33.95, it would be better to hold off on short entries and instead look for a false breakout at 34.16 or a rebound from 34.40, aiming for a 20-25p downward move. Much will depend on upcoming UK inflation data, which could significantly influence intraday volatility. In the event of a sharp drop in the pound, buyers are likely to step in around 33.64, where long positions could be considered on the false breakout. Additional long opportunities may emerge at 1.3335, also on the false breakout, or at 33.13 on a rebound, targeting a potential 20-25 pip upward correction. Best of luck to everyone.